All right, let's dive right into this explainer. Today, we're taking a look at capital markets and what we're calling the valuation mystery. We're going to look way past the basic accounting to uncover how global markets actually measure and, more importantly, reward true corporate success.
Okay, before we get bogged down in all the heavy metrics, I want you to ask yourself a super simple question. Let's say you wake up tomorrow and boom, you suddenly have exactly 1 million pounds sitting in your bank account. What are you going to do with that capital? Well, you essentially have three options. Option one, you could lock it in a bank safe. It's totally secure, but it's definitely not going to grow much. Option two, you could start your own company, taking on all that operational risk yourself. Or option three, you could invest in somebody else's company. This third option, it's the exact reason the capital market even exists. It connects the people who have capital with the people who need it to build businesses, all to answer one absolutely crucial question: which company actually deserves your investment?
And that brings us to what's known as the profit paradox. This completely challenges the everyday assumption that a company's current profit tells you exactly what it's worth. Let's look at a quick comparison here. Say company A makes 10 million pounds in profit and company B makes 100 million pounds. Just on the surface, you'd probably think company B is automatically worth 10 times more, right? Well, the market says not necessarily. I mean, what if company A is this highly innovative startup growing like wildfire, while company B is completely stagnant, mature, and has literally zero growth prospects? The market actually assigns value based on way more than just today's isolated profit number. So here is the absolute crucial point to remember. Investors are not putting their money into past buildings or yesterday's products. They are buying future profits, future cash flows, and future growth. When you invest, you're fundamentally looking forward. You aren't buying the machines a company already bought or the products they already sold last year. You're really asking one defining question: how much future value can this business create? The value of a company today is entirely dependent on its ability to generate cash well into the future. So if you put this all together, it builds this really clear chain. It takes us all the way from the backward-looking accounting mechanics of profit straight to the forward-looking market expectation of company value. On the front end, we have the accounting mechanics, things like profit, which looks backwards at what already happened, and cash flow, which is the actual operating reality. But then we cross over into market valuation. The company uses that cash flow to power its internal engine, which is value creation. And finally, that internal creation translates into company value, which is entirely based on the market's expectation of what happens next. To really peel back the layers of the onion here, we've got to strip down the income statement layer by layer, moving from raw operating cash generation all the way down to the final bottom line. You hear the word profit thrown around constantly, right? But there are actually distinct tiers. At the very top, we have EBITDA, earnings before interest, taxes, depreciation, and amortization. This is your raw operating cash. Strip away the wear and tear on your assets, and you get EBIT, your operating profit. Finally, once you deduct your interest and income tax, you arrive at net profit, the final bottom line available to the owners. It's what the accountants obsess over. But is net profit the final word on whether a company is truly successful? Well, the short answer is no, because as we've established, net profit just isn't enough. A business actually has to earn more than the costs of the capital it uses. Think about it. That capital provided by investors, it's definitely not free. There's an expected return on that money. So the ultimate tool for an analyst to measure a company's true internal economic health is economic value added, or EVA. It answers the fundamental question. After paying for all the raw materials, the salaries, the taxes, and crucially, the cost of the capital itself, is this business actually generating a true surplus? I love this analogy. Think of a company's internal engine like a giant seesaw. Value is exclusively created when the balance tilts in the right direction. On one side, pushing up, you have your return on capital employed, or ROCE. This is the strength driven by your sales and how well you use your assets. But weighing it down on the other side is your WACC, the weighted average cost of capital. That's the heavy burden driven by the cost of debt and equity. And the absolute golden rule of corporate finance sits right there in the middle. Value is created only when your returns are heavier than your costs. By placing these two metrics side by side, we can really contrast a company's internal operational truth with how the external market actually rewards those efforts. So EVA is our internal performance engine. It asks the cold, hard question, are we generating returns above our cost of capital today? But then we introduce MVA, or market value added. And this shifts our focus entirely to the external market hype and the market's verdict. MVA answers a totally different question. How much premium is the market placing on this company's future?
Market value added is essentially the massive expectation premium that investors are willing to pay above the physical book value of the firm. Think about the total capital investors have actually put into a business. That's the book value. But the total market value of the firm, that's usually much, much higher. That enormous gap between the actual money put in and the total market value today, that is the MVA. It is literally the financial embodiment of future expectations. So all of this creates a bridge spanning the past, the present, and the future. The first pillar is the accountant's rearview mirror, grounded in historical operational yield like net profit. The middle pillar powers the business forward right now, calculating capital efficiency through the EVA engine. And the final pillar, the one holding up the forward path of the bridge, is the market reward, the MVA. That's the premium paid right now for the expectation of a continuously positive EVA in the future. And this brings us to the ultimate mystery of why certain companies are worth trillions. You absolutely know the names: Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, Nvidia. The Magnificent Seven. Investors are willing to pay astronomical sums for them. But why? Is it just their current profitability, their innovation? Actually, the answer lies in everything we've just covered. They represent the absolute apex of future expectations. The market strongly believes their internal engines are so robust that they're going to generate immense economic value added for decades to come, resulting in a staggering market value added today. All right, now it's your turn to step out of the audience and into the shoes of an investment analyst. We're going to apply this theory to reality. Your objective is to take the provided intelligence file, the Mag7 EVA MVA data, and investigate the explicit relationship between these metrics for these specific companies. We want to see if the internal economic realities of these massive corporations actually match up with the staggering external verdicts handed down by the stock market. To do this, we're going to follow a precise 4-step computing procedure for the Magnificent Seven between 2020 and 2025. Step 1 is visual interpretation. Then step 2, statistical analysis. From there, we move into step 3, dynamics visualization, mapping out the trajectory of each individual company. And finally, step 4, culminating in a strategic synthesis. So as you dive into these numbers, I really want you to ask yourself, are these astronomical valuations truly justified by their internal economic engines? When you perform your strategic synthesis, you're looking for cross-company insights to solve this valuation mystery. Are the companies with the highest internal EVA consistently receiving the highest MVA premiums, or is the market just blindly paying for a future that the internal math simply doesn't support yet? It's a massive question. Let's see what you find.